Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today, we're looking at SpaceX, ticker SPCX.
If you find our talks useful, please consider subscribe, like, and comment underneath, and check out the special 14-day trial link below in the description for StockOracle.
Right, and just as a quick reminder, StockOracle is an AI-aided stock research platform we use to help frame today's analysis.
Yeah, and that link below is an affiliate link, meaning the channel may earn a commission at no extra cost to you. But we have to stress, this is not financial advice or like a trading signal service.
Definitely not. And keep in mind, StockOracle's AI insights and valuation estimates, well, they can be incomplete or wrong. So always verify important facts yourself. We are not telling you to buy, sell, or hold.
Exactly. So jumping right into the wealth building context today, imagine building the most advanced, profitable space network in human history.
Right.
You completely dominate orbital launches. You just secured a $1.6 billion contract from the Space Force, and you essentially hold a monopoly on low Earth orbit.
Which is an incredible position to be in.
It is. But then imagine intentionally hitting the brakes on your most reliable rockets to bet the entire company on a completely unproven AI war against terrestrial tech giants, companies that have never even left the planet.
It defies traditional corporate strategy, You rarely see a company achieve near monopoly status in a highly difficult physical industry, only to pivot its primary capital focus toward a software and infrastructure battle.
Especially when they are the underdog against immensely capitalized hyperscalers. That is exactly what SpaceX is doing right now, and the market is really struggling to price in the sheer audacity of this pivot.
Yeah, the volatility is wild.
It is. Just to set the baseline for you guys listening, the stock is down almost 30% year to date. It is sitting 44.5% below its 52-week high, so well underwater from its $135 IPO price.
But then you look at the tape today and it just experienced this massive 9.4% post-earnings pop.
Right, trading around $125.33 right now, and the beta on this stock is 5.36.
Which is just extreme.
Yeah, it moves with more than 5 times the violent volatility of the broader market. So, the goal for our talk today is to unpack the fundamentals of this high-stakes pivot, dissect the catalysts behind their massive cash burn, and figure out how this stock survives a $100 billion market event happening tomorrow.
And that volatility you mentioned, it's directly tied to the fundamental tension in their earnings report.
Yeah.
You cannot look at today's 9.4% pop without looking at the underlying duality of their business model.
Because they're basically operating 2 completely different companies under one ticker right now, right?
Exactly.
So let's look at the fundamentals causing this whiplash. On the top line, Q2 2026 revenue just hit $7.81 billion.
Which is huge. That is a massive 92% year-over-year jump.
Yeah, absolutely. Crushing Wall Street estimates of $6.88 billion. And it's also this huge acceleration from the first quarter, which, only saw 15% growth.
Right. So the Starlink engine, with its 10 million active users, is just pulling serious weight. The top-line acceleration is undeniable at this point.
They're pacing toward over $18 billion in full-year revenue for 2025.
Yeah, showing they've largely solved the consumer satellite broadband puzzle. But the financial tension really lives in the cost of their new ambitions. The revenue engine is roaring, but the capital furnace is just burning hotter.
Because the bottom line looks like a crime scene. They posted a $4.9 million net loss in GAAP profitability for 2025.
Yeah, that's a tough pill to swallow.
And it is almost entirely traceable to XAI, the segment they acquired in February 2026. That division alone bled $6.35 billion in operating losses.
It's staggering.
It feels like they've built this perfectly efficient, a galactic toll road with Starlink's recurring subscription revenue. But instead of banking those tolls, they're just shoveling the cash straight into an experimental AI furnace.
That's a great way to put it. The toll road generates cash, but the furnace requires a different type of fuel entirely. And right now, Wall Street is fracturing over which metric actually reflects the health of the company.
Right, GAAP versus adjusted.
Exactly. If you rely strictly on GAAP generally accepted accounting principles, you see those terrifying net losses. And that's because GAAP accounting forces a company to recognize the massive depreciation and, the upfront setup costs of building out AI data centers.
Right, purchasing all that specialized hardware.
Yeah. But management obviously wants everyone looking at adjusted EBITDA instead.
And looking at the breakdown, you can definitely see why. For Q1 2026, adjusted EBITDA was a positive $1.13 billion.
Which is healthy.
And analysts are forecasting Q2 to come in around $2.1 billion, with full-year expectations nearing $17.3 billion. So the core business of launching hardware and beaming internet, it actually makes money.
Right, and that distinction proves the foundational business model works. The adjusted numbers strip out those one-time acquisition costs and the brutal depreciation of the AI hardware.
But, ignoring JAP entirely is pretty dangerous here, isn't it?
Oh, absolutely. Those massive operating losses from XAI represent real dollars leaving the balance sheet. They need that money to secure supply chains, hire specialized engineering talent, and basically build out unprecedented infrastructure.
Well, looking at catalysts and future growth, funding that infrastructure exposes a strategic contradiction in their capital allocation that I'm really struggling to parse.
How so?
So S&P Global predicts SpaceX will spend $68 billion in capital expenditures over just the next 12 months.
Yeah, the CapEx is astronomical.
And they have $350 billion in planned CapEx through 2030. Because of this massive outlay, they aren't even projected to hit positive free cash flow until 2029.
Which is a long time to wait for a company valued this highly.
Exactly. And right in the middle of this cash crunch, they acquire the AI coding company Cursor for $60 billion.
Right.
Now, I know it was an all-stock deal, but diluting your equity by $60 billion while staring down a $350 billion CapEx barrel, that seems inherently reckless.
I get why it looks that way, but you have to understand they structure deals like Cursor as all stock, specifically because they are staring down that CapEx barrel.
So they're just protecting their cash.
Exactly. When you're modeling out that kind of physical infrastructure spend over 4 years, liquid cash is your absolute most precious resource. You use your equity as currency to preserve the balance sheet for the physical hardware like the actual servers, the cooling systems, the Starship development. You cannot afford to drain your cash reserves on software acquisitions, even really vital ones, when you literally need to buy tens of billions of dollars worth of NVIDIA chips.
Okay, I understand preserving cash, but I still don't understand the logic of the pivot itself. They dominate orbital launches. The Space Force just handed them a $1.6 billion contract for 18 Falcon 9 launches through 2027.
Yeah, they effectively own low Earth orbit.
So why are there reports that they are turning away Falcon 9 customers beyond 2028 and halting production of their most reliable rocket? Why risk a near monopoly in space to pick fights with terrestrial mobile networks like AT&T and well-capitalized AI hyperscalers when you already print money in orbit?
It comes down to the total addressable market. The market for launching physical satellites has a hard ceiling. Yeah, even if you launch every satellite for every sovereign nation and private company on Earth, it's still a finite revenue stream. Management realizes that to justify a post-IPO valuation that scales into the trillions, they cannot just be a logistics and delivery service for space hardware.
So they need to own the infrastructure of the next economic era, not just the trucks that deliver it?
Exactly. They are attempting to move from being a launch provider to being the foundational layer of the global AI and telecom economy. Think about the mechanical bottlenecks terrestrial AI data centers are hitting right now.
Like the power grid issues.
Yes. Hyperscalers are draining local power grids and running into massive thermal limitations just to keep their NVIDIA clusters from melting down. SpaceX's long-term bet is that orbital data centers powered by uninhibited solar energy and naturally cooled by the vacuum of space can just bypass terrestrial energy constraints entirely.
Oh, wow. So Starship isn't just a bigger cargo rocket for Mars colonization anymore. It is the delivery mechanism for flying server farms.
Exactly.
They are trying to retrofit a massive, unproven AI tech stack onto their space monopoly. That completely clarifies the Cursor and XAI acquisitions. They aren't just launching hardware. They want to own the software layer, generating the compute natively in their own ecosystem.
Right. The integration of XAI and Cursor means they're trying to build a vertically integrated pipeline, all the way from the physical orbital server down to the coding assistant the enterprise client is typing into.
But the hyperscalers there are challenging. Companies like Amazon, Microsoft, Google, they've been building terrestrial infrastructure for a decade. They generate tens of billions in free cash flow every single quarter.
Yeah, the competition is brutal. SpaceX is trying to leapfrog them by moving the battleground to orbit, But the latency physics and the data transmission mechanics of orbital compute, they're entirely unproven at commercial scale.
And that unproven leap perfectly explains the sheer panic and euphoria we are seeing when we look at sentiment and technicals. I mean, we were looking at a massive $173 spread in analyst price targets.
It's one of the widest spreads in the market right now.
Yeah, FactSet consensus is sitting at $236.71, backed by 7 buy ratings. Meanwhile, Morningstar's analyst is flying solo with a sell rating and a fair value target of just $63. On a stock currently trading around $125, a spread that wide means Wall Street doesn't even agree on what industry SpaceX is actually competing in.
Well, the modeling assumptions driving those two targets are basically operating in alternate realities. The $236 price target requires pricing and flawless compounding execution.
Like perfection across the board.
Exactly. The bulls are modeling that Starlink's average revenue per user, the ARPU, will expand effortlessly as they transition from just rural internet to foundational terrestrial mobile networks. And more importantly, those bullish models are pulling forward billions in hypothetical high-margin AI contract revenue.
Right, they are just assuming the orbital data centers work, the transmission latency is solved, and enterprise clients actively ditch traditional cloud providers for SpaceX's infrastructure.
Yeah. But then the Morningstar bear thesis, targeting $63, looks at that $6.35 billion operating loss from XAI and models it not as a temporary setup cost, but as a permanent structural drag on margins.
Yikes.
If the orbital AI infrastructure fails to gain enterprise traction, or, if terrestrial energy bottlenecks are solved by small modular nuclear reactors down here on Earth, SpaceX is left holding billions in obsolete NVIDIA chips in space.
And if that bearish scenario plays out, the current valuation is fundamentally terrifying. I mean, even after a 52% plunge from its June highs of $225, this company is still trading at 35 to 37 times projected 2026 revenue.
Not earnings.
Right. We are talking about a sky-high revenue multiple for a company that isn't expected to generate free cash flow for another 3 years.
A multiple like that leaves zero margin for error. It requires a pristine growth narrative. Any disruption to the engineering timeline or delay in Starship's reliability metrics, or even any miss in quarterly Starlink user growth, makes a 35 times revenue multiple mathematically indefensible to institutional investors.
Well, I was looking for signs of internal sentiment to justify that multiple, and I stumbled on a massive anomaly in the trading data.
Oh, the squeeze watch metric.
Yes. The squeeze watch metric recently flagged 3.5 billion shares of net insider buying over the last 90 days. Now, on paper, that looks incredibly bullish. It paints a picture of executives backing up the truck and buying their own stock because they believe in that $236 price target.
Right.
But given the cash burn and the capital intensity we just discussed, there is no way executives are buying billions of dollars of stock on the open market right now.
Yeah, you really have to look under the hood of how market data aggregators classify transactions for newly public companies. Those 3.5 billion shares are not executives logging into brokerage accounts and buying shares at 125.
So what is it?
When a company goes public, restricted stock units, RSUs, and legacy executive stock options begin to reach their vesting milestones.
So it's an accounting mechanism triggering the sentiment algorithm.
Exactly. The algorithmic aggregators scrape SEC Form 4 filings. The vesting of an RSU is mechanically recorded as an acquisition of shares by an insider. Plus, executives frequently execute complex internal restructuring, like surrendering a portion of their vested shares back to the company just to cover the massive income tax liabilities generated by the IPO.
So these automated, non-discretionary corporate actions basically flood the filings and trick rudimentary algorithms into flagging massive insider buying.
Yes, it is a false positive for retail investors looking for fundamental conviction.
Which is a crucial distinction to make, because the reality of insider sentiment is about to be violently tested. We need to talk about the risks and the bear case, specifically the structural event happening tomorrow, August 6th, 2026.
The lockup expiry.
Yes, up to 911.5 million shares currently held by employees and early investors suddenly become eligible to trade on the open market.
We are looking at a potential overnight float expansion from 639 million tradable shares to 1.55 billion.
That is massive. At recent market prices, that newly unlocked tranche of equity is worth over $100 billion. Now, Elon Musk's personal equity is contractually locked up until mid-2027, so the founder isn't dumping shares.
Right.
But still, $100 billion worth of equity suddenly entering the wild is a massive supply overhang. Here is my issue, though. We live in a highly efficient market. The speculative markets seem completely unfazed by this. Traders on Polymarket are currently assigning a 95.3% probability that SpaceX stays above $90 through the end of the month.
Interesting.
Yeah, so if institutional investors and hedge funds know this unlock is happening tomorrow, hasn't the smart money already priced in the dilution?
Well, the concept of pricing in works efficiently for foreseeable fundamental events like, an upcoming earnings report or an interest rate decision. It does not neatly apply to the physical mechanics of a massive supply unlock.
Okay, why not?
Polymarket is measuring trader sentiment, which is currently heavily skewed by today's 92% revenue beat. But institutional absorption is a mechanical limitation, not a sentiment indicator.
Meaning, even if a mutual fund desperately wants to buy SpaceX, they only have a finite amount of cash allocated for the position.
Exactly. If early employees who have had their personal wealth tied up in illiquid SpaceX equity for over a decade decide they want to buy houses, pay off debt, or simply diversify their portfolios away from a single highly volatile asset, they will sell.
Yeah, you can't blame them.
Right. And if even 10% of those 911 million shares hit the bid tomorrow, that is roughly 90 million shares of new organic selling pressure. If institutional liquidity cannot instantly match that volume, the price floor collapses, regardless of how optimistic retail sentiment is today.
Wow. And if that price floor breaks, it gets fundamentally dangerous for the company's underlying strategy. Because if they dilute their equity value too much, their ability to use all stock deals like they did with Cursor just evaporates.
Exactly. They need a premium share price to act as currency to fund that $350 billion in CapEx. The valuation is the currency.
That's a great point.
Furthermore, if you look ahead to the Q3 earnings call in November, the stakes become exponentially higher. If Starlink ARPU metrics miss expectations, or if management fails to announce tangible enterprise contracts for the XAI orbital infrastructure, the market will punish the stock, and any downward pressure will be severely magnified by the sheer size of this newly doubled float.
So, synthesizing all of this, let's move to the final verdict. What is the actual takeaway for you, the listener, trying to analyze this stock today? Based on our research into the financial filings, analyst notes, and market mechanics, our bullish score sits at a neutral 5 out of 10.
Yeah, it is a strict wait-and-see situation for the long-term view. The 92% revenue jump and the 10 million Starlink users, well, they definitively validate the core business model.
But entering a position right now means knowingly taking on the risk of extreme capital intensity, an unproven orbital AI strategy, and a $100 billion supply overhang.
Exactly. We always explain both the upside and the downside clearly here. And the technical level you really need to watch over the next few days is the 52-week low of $104.83.
If the stock can absorb tomorrow's lockup expiry without breaking that floor, the bulls might have a structural case that the market has enough organic demand to swallow the dilution.
But if that support level shatters, the technical damage could take years to repair. The physical market mechanics will dictate the reality over the next 48 hours, and that overrides any long-term fundamental narratives.
Totally. So before we sign off, just a reminder to subscribe, like, and comment underneath if you enjoyed our analysis today.
And definitely grab that special 14-day trial link below in the description to access StockOracle so you can dive into these metrics yourself.
I want to leave you with a final puzzle to chew on, one that builds on everything we've explored. We started by looking at a space company intentionally halting production of its most reliable rockets to fight terrestrial tech giants. SpaceX is risking a near monopoly in orbit to build the foundational infrastructure of the next AI economy. Right. So consider this. What if the ultimate success or failure of the greatest space exploration company in human history isn't determined by getting to Mars, but by whether it can win a data center war against companies that have never even left Earth?
That is the multi-trillion-dollar question.
It really is. Keep your eyes on the tape tomorrow, folks. It's going to be a wild ride.